panel. I'm Louise Shaner, a senior fellow here at Brookings and at the Hutchins Center. So our first panel is going to be on loan burdens and defaults, failure of the repayment system, or failures in accountability. And I'm going to reintroduce Adam, who's going to come up and talk about this. Adam is my colleague here. He's the Joseph Peckman Senior Fellow in Economic Studies at Brookings, visiting this year at the University of Utah Business School. So he's going to do the first presentation. The second presentation is going to be by Dubravka Ritter. She's a senior research fellow at the Consumer Finance Institute at the Federal Reserve Bank of Philadelphia, and has been doing a lot of work on student loans for a long time. So, and after they do their presentations, we're going to sit here, have a brief discussion with me, and then open it up to you guys, as I know there are a lot of people who are going to have a lot of good questions in this audience. So, Adam.
Okay, thank you. I'm back again. Okay, so I interpreted this, the purpose of the panel, to talk about why students struggle with their loans and what we can do about it. We framed it in some ways as a discussion of the accountability system, the set of rules that determine what schools, what institutions and what programs are allowed to participate in the loan program, and the rules that apply to those institutions, the kind of what, where, how much students can borrow to go to which schools. Versus the repayment system, which describes how borrowers repay their loans after they leave school, and it's intended to keep those loan burdens manageable and to make sure that to protect both taxpayers and the students themselves. And so borrower outcomes have clearly gotten worse over time. So I think part of the question is, are those poor outcomes because today's students have gone to lower quality or higher cost or lower return or lower value institutions? And if that's the problem, it suggests some sort of failure in our accountability system. If instead students are mostly investing in a high-quality education, but are somehow the victims of rising costs, or are more likely to face other risks that borrowers in the past have not faced, like being from poor families or entering into a worse labor market, then we should be concerned that we're demanding too much of those borrowers after they leave school, which I can think of as a failure in our repayment system. I'm sure that the right answer is both, but I'm going to give you the case that the big change is that we increasingly make loans that we know borrowers will struggle to repay, mostly based on the institutions they attend and the amounts that they borrow. So if you asked me why so many borrowers struggle with their loans, I would say it's because we make them loans that we know that they're going to be unable to repay. And we encourage the students to take us up on that offer. We make undergraduate students loans to attend programs where few people finish, where those who finish don't get good jobs, and where, when they do get jobs, those jobs don't allow them to repay the loan. I think we make graduate students loans that are limited only, well, we make graduate students loans that are limited only by the cost of attendance, tuition and fees, plus living expenses, which has led to some students borrowing very large amounts, far in excess of their ability to pay. In the past, borrowers that had large balances were, we called them doctors. Today, there's a wide variety of graduate students who can accumulate very large balances, but don't have the earning power or financial return that doctors did. And those borrowers struggle with their loans and I think cost taxpayers a lot in subsidies. And finally, we lend to parents in very large amounts, but without regard to whether they have the ability to repay those loans. I think parents are maybe a little bit at the fringe of the accountability issue because it's not necessarily about which institutions those parents are borrow, but in the sense of why do so many people borrow? Why do so many borrowers struggle with their loans? It's in part because we make loans to individuals who don't have the ability to repay. And unlike for undergraduates and graduate students, when parents default, we garnish their wages and their Social Security, and we take away their tax refund. And so the penalty for default is much harsher. And so I think if the federal government had stronger rules for how financial aid could be used, then students would get higher quality education. They'd be less likely to struggle. And the costs on borrowers and taxpayers would be reduced. So why do I think this? Well, for undergraduates, I think the problem isn't necessarily how much students borrow. As I think the next panel will get into, the amounts that undergraduates can borrow is limited, and the amounts that students have borrowed each year they are in school has barely changed in 50 years. True, some students are taking a longer time to complete a degree, and some undergraduate borrowers who are older and independent can borrow more. And so some people accumulate larger loan balances than they have in the past. But on an annual basis, it's hard to look at the pattern in this chart and see that there's been an explosion in the amount of debt that people have accumulated. And I think it's also hard to look at the job market, particularly the market for people who have BAs, and conclude that something catastrophic has happened to people who have a good quality degree in terms of getting a job and earning wages. Instead, I think the big change in the undergraduate lending market is where students get their degrees. This chart shows the number of student loan borrowers who are leaving school and beginning to repay their loans in the year 2000 versus 2001. And so what you can see is that the number of student loan borrowers has increased at every type of institution, but far and away the largest increases in borrowing have been at for-profit schools. To a lesser extent, borrowing has also increased at community colleges and at the least selective schools. It's at these schools where students are less likely to complete a degree. When they do, they're less likely to get a job, and they really struggle to repay their loans. And indeed, this is not a new problem. This chart shows the student loan default rate each year back to 1970. So the red line is the default rate. The blue line is the share of student loan borrowers who have attended for-profit schools. And what you can see is that when the blue line goes up, 2 years later, the default rate goes up. When the blue line goes down, the default rate goes down, and then in the 2000s, as the blue line has started going back up again, the default rate has gone back up again. Indeed, without any controls for things like the cost of college, the unemployment rate, or economic conditions, or the share of borrowers that are low income or minority or first generation, this simple relationship between the for-profit share and the default rate suggests that the for-profit share explains 90% of the variation in default rates over time. So I take this as evidence that a lot of the bad outcomes are largely the result of where people go to school rather than the characteristics of the students themselves. And indeed, a lot of the pattern in the default rate, the rise and fall and rise, are the result of our accountability system. We expanded the types of schools that were eligible for loans in the 80s. That led to a crisis that was ended by instituting a new accountability system based on default rates and the share of revenues that schools derive from federal aid. And so we rapidly arrested that problem in the early 90s, and in part it's the unwinding of those rules that we had imposed then that has led to the reemergence of defaults. For graduate borrowers, I'd say the story is similar in the sense that there have been big changes in where students have gone to school and the types of degrees they pursue. But for graduate borrowers, there's also a big increase in the amount that they borrow. So this chart just shows the average annual amount borrowed by graduate students each year they're enrolled in graduate school. You can see there are two big upticks, one in the early 90s when we raised the graduate student loan limits, and again after 2006 when we eliminated the limits that grad students, the statutory limit on how much graduate students could borrow, and instead went to a system where graduate students can borrow up to cost of attendance. What you can see is that after those changes, the amounts that graduate students can borrow increased a lot, and this is on an annual basis. So graduate students can borrow without lifetime limit. And so some students enrolled for many years or in higher cost programs can accumulate much larger levels of debt. In addition to the amounts that graduate students borrow, there have also been changes in where they go to school. This is a little bit aggregated in the sense that you can see that the for-profit share has increased. You can see that also that there are increases in the number of graduate students who are borrowing at private and at public schools and private nonprofits. And I think this kind of understates the changes that are emerging. And just to put a fine point on it, I have plotted here the data from the college scorecard that shows the average debt by program of study for California law schools and compared that to the California bar pass rate. So, for instance, what this chart shows is that the average student who graduates with a law degree from Stanford University has borrowed about $120,000 from the federal government to finance that education. 91% of them go on to pass the California bar on the first time they take it. And then on the right-hand side, you'll see schools like Whittier and Thomas Jefferson, where the average amount that those students owe is $190,000. The Whittier bar pass rate is 22%, and at Thomas Jefferson, it's 31%. So these are students who the federal government has loaned $200,000 to, who we know are not going to become lawyers. And that seems like a terrible burden to put on the students, and a costly choice for taxpayers. I could give you more examples like this. USC's online master's degree in social work, students leave there with an average debt of $109,000. And in those cases, it seems like an avoidable problem in the sense that students who go and get their master's degree at UCLA or Cal State LA borrow on the order of $30,000 and even less at Cal State. And then I would just briefly say that some parents end up with predictably bad loans that they can't pay. Like graduate loans, parents face no lifetime limit, and their annual borrowing amounts are limited to cost of attendance. Many of them take out loans that they will struggle to repay. For instance, about 8% of the parents of students who are poor enough to qualify for a Pell Grant take out a PLUS loan. The average PLUS borrower took out $16,000 in 2014. As this chart shows, overall the average balance of a PLUS borrower when their child leaves school in that year was about $39,000, and 9% of them owed more than $100,000. Just to put a fine point on it, that generates a large number of parents who can't pay their loans. For instance, this chart shows the distribution of income of black and white parent borrowers. Only about 15% of parent borrowers are African American and 63% are white. But you can see that African American parent borrowers tend to be much poorer. About a third of them earn less than $30,000 a year. It's inevitable that they are going to struggle with these types of loans, and then when they do struggle, there's not a policy that helps relieve their burdens, and so they go right into the Treasury offset program, which claws back their Social Security and tax refunds. I'm not exactly sure of the split, but in 2017, the Department of Education clawed back $2.8 billion from borrowers who were delinquent on their debts through those mechanisms. I think many of them were parents. And so we offer them these loans that we know they can't repay, and then when they can't repay, we go after them with the full force of the government. So to conclude, my view is that many of the problems that student borrowers face today stem from an erosion in the quality or value of the educations that they're pursuing, or at least that those that are financed with federal aid, and that we can improve their outcomes by changing where and how much students can borrow. That could mean limiting institutions' eligibility for federal aid, but it could also be to use grants, for instance, to pay for exclusively for high-quality programs, as is kind of implicit in many free college proposals. We haven't talked about repayment, but I think we will. So I think if we got the front end right and issued loans in conditions where we could reasonably expect borrowers to repay, then income-based plans would make a lot of sense because they would offer insurance to borrowers without systematically subsidizing low-quality programs. So that concludes my remarks. Thank you very much.
Good morning. It's a true pleasure to join this fantastic lineup of speakers and discuss borrower experiences with student debt with you today. I want to thank the event organizers for inviting me to discuss this difficult and very policy relevant question, and thank you for the warm welcome. I would like to spend the time that I have today to build upon Adam's remarks and provide some evidence of repayment challenges, particularly for disadvantaged students, even when they attend what we might consider as good schools. I will also touch upon how the complexity and administrative inefficiencies in our repayment system can contribute to these bad outcomes. First, I want to illustrate an important aspect of outcomes in higher education generally, and for student debt in particular. Averages conceal a lot of variation. That can be the alternative title of my presentation. To do this, I'm relying on a rich data set of school-level metrics on the composition of the student body and on post-college earnings and loan repayment outcomes. That's the college scorecard. Many of you in the audience will be familiar with this data set. Now, Adam already introduced the finding that borrowers have very different outcomes in terms of default rates by the school sector. So private, non-for-profit, private for-profit, and public. I will show you a couple of additional metrics in my remarks. So if we look at earnings 10 years after enrollment, from the 2014 to 2015 data set, borrowers would have enrolled for the first time in these institutions 10 years earlier. Mean earnings don't look terribly different by sectors. Part of that is that I have excluded graduate-only and certificate-only institutions out of this data set so that we can do a more apples-to-apples comparison. So I focus primarily on institutions that grant associate's degrees and BA degrees. The earnings data is only for students who borrowed, which has its advantages and shortfalls. Now, 3-year repayment rates, similarly to default rates, look considerably worse at for-profit colleges than at public and private non-for-profit colleges. In fact, they're about half of the repayment rate for nonprofit institutions. The 3-year repayment rate, by the way, is a low bar. It measures the share of the repayment cohort that reduced the balance of their loans by at least $1 3 years after entering repayment. And I should say that the patterns are pretty similar if you look at 5-year repayment rates or 7-year repayment rates instead. We also know that post-college outcomes differ by the borrower's pre-college context, experience, and preparation, all of which are highly correlated with things like socioeconomic background and specifically income. So unsurprisingly, outcomes are worse for lower-income borrowers, as Adam already mentioned. Here I show mean earnings by the borrower's family income at the time of enrollment. Borrowers are split into 3 groups: family income less than $30,000, $30,000 to $75,000, and then 75 or more. So mean earnings are 25% higher for this middle income group relative to the low income group, and 50% higher on average for the high income group. If you break down the analysis into considering primarily associate degree granting, so community colleges and 2-year for-profits, and separately for 4-year schools, you will see that the 2-year public institutions are driving the results for, pardon, I skipped ahead a little. So 3-year repayment rates are similarly worse for lower income borrowers. So it turns out that lower income borrowers are concentrated at 2-year public and for-profit schools. Here I highlight the share of borrowers that come from low-income families, so with income of less than $30,000. If you break down the analysis here into considering primarily associate granting and bachelor granting institutions, you will see that it's the 2-year public institutions that are leading the results over for the public column. Then we can look at how lower income borrowers fare in different types of schools. It turns out that they do worse relative to other students in the same type of school. Looking at earnings, this is true even at public, so the first set of columns are public universities, the middle private nonprofit, and the last is private for-profit. The dispersion within schools certainly is higher at for-profit schools, though. So the downside risk to earnings is higher. The same holds true for repayment rates. In fact, lower income borrowers at nonprofit schools look more similar to the average student in for-profit schools than to their higher income peers in the same type of school. What if we looked at high default and low default schools separately? We tend to think that schools with low defaults produce generally good outcomes. I define low default institutions as those with a 3-year default rate below the median of about 13%. But even at those institutions, lower income borrowers have much lower repayment rates than their middle and higher income peers. Note that this data is from 2014-2015, so enrollment and income-driven repayment really isn't driving the repayment rates down by a whole lot at this point just yet. Interestingly, the pattern holds true even if we put aside the for-profit institutions and focus on the nonprofits. Lower income borrowers aren't doing great. So on the left chart is for public colleges and the right is for private nonprofit colleges. And systematically, the lower income students at nonprofit universities aren't having repayment rates that exceed 50%. By the way, if you reproduce this chart for for-profits, there's not much difference between the low default and high default schools in outcomes along student loan repayment. They are universally poor. So you should take 3 main takeaways from the discussion so far. Borrowers at both for-profit and nonprofit certificate programs have by far the poorest outcomes. Among associate and BA degree focused schools, lower income borrowers have worse outcomes and for-profit and low-quality nonprofit schools. But lower income borrowers aren't doing very well, even at what we would consider high-quality nonprofit institutions. Now, I chose to highlight differences in outcomes today to illustrate a point, but research papers using individual level data have done an analysis in the same spirit as this, much more comprehensively. So for those of you who are inclined to read more in-depth and technical reports, you can look at Adam's 2015 paper and Judith Scott Clayton's 2018 paper. They're both published through Brookings. And papers like this consistently find that borrowers from disadvantaged backgrounds struggle the most with student loan repayment, even when taking factors like school quality into account. On the flip side, individual characteristics, the state of the economy, and other observable factors that might affect school repayment metrics cannot account for the disparities in performance between nonprofit and for-profit schools, with for-profit schools consistently doing worse. So we will need to think about both school level and individual level policy solutions to improve student loan repayment. I'd like to take the rest of my time to talk about the ways in which our complex and inefficient repayment system may have contributed to poor repayment outcomes for borrowers. For one, we have far too many repayment and forgiveness plans, as well as ways to pause payments available to borrowers. The rules are different depending on the program through which the loan was obtained, whether it's a direct loan or a FFELP loan. And these complexities both produce a significant challenge to the loan servicing process and complicate decision-making for borrowers, many of whom are inexperienced with loans and have dynamic and unpredictable employment paths, especially right after graduation. And choice of repayment plan can be affected by family circumstances, and in turn, it can affect tax returns, family formation, and borrowing for other purposes. It is an extremely complex decision. As someone who has spent considerable amount of time studying student loan borrower credit records, I can tell you the end result is not pretty. To add to this, we spend a fraction of servicing expenses that banks do for other kinds of loan products on student loan borrowers, and not enough time guiding families through the complex financial aid system before they even take out loans. We see the result of our low investment in the often negative experiences of struggling student loan borrowers with their servicers. On top of that, the way borrowers apply for income-driven repayment, verify their income, and the way payments are collected from borrowers are terribly inefficient relative to systems in other countries. Some of these issues could be improved by automating enrollment in income-driven repayment and by piggybacking on the tax system for income verification and payment processing, as many of us have advocated for years. To conclude, let me emphasize that borrowing for higher education carries risks of repayment problems for borrowers, and these risks come from many channels. Some of them are predictable before enrollment, while others are not, and both require different policy solutions. Borrowers can struggle with repayment due to low or unreliable earnings, some of which can be attributable to their individual characteristics, and some to their school. Borrowers can also experience unexpected bad shocks, which are not easily predictable at the individual level. Complexities and administrative efficiencies in our repayment system can render borrowers enrolled in suboptimal repayment plans and make navigating repayment a source of significant stress for families. Sadly, students from disadvantaged backgrounds bear the brunt of the risk for these poor outcomes. On that lovely note, I'll wrap up. Thank you.
Well, thank you both for really interesting presentations. So to step back a little bit, so looking at both of all the presentations this morning, there's clearly a lot of student debt out there, which is a new thing. There's more defaults, but the monthly payments look reasonable. The returns to education are really high. So is there a crisis? Is it a $1.5 trillion crisis? Is it a smaller crisis? And if it is a crisis, who's the crisis for? Is it for people, for which people who've been borrowing it, or is it for the taxpayer? What's kind of the big picture? Let's start with you, Adam.
Well, I think that there are parts where it's clearly a crisis, where I think that a lot of people attend schools that they don't finish, for instance, often, for instance, for-profit schools where they can't finish, they accumulate a lot of debt. The program that they have studied hasn't helped them find a job. I think for those students, it's clearly a crisis. And I think for a lot of the groups that identify graduate students and parents, some of them are struggling. I would like to emphasize that for a lot of people, it's a lot of people are well served by their educational institutions. People who got a BA degree at a good four-year institution, who have borrowed reasonable amounts to finance that education, I think that they are well served, and we shouldn't confuse the problems of some of these groups with the fact that for many mainstream borrowers, the system can work quite well.
I agree with everything Adam just said. And I would just add that, consistent with what I showed, I think the crisis is for the families with the fewest resources. And we have chosen the student loan system in part to address the gap between what institutions and federal grants and state grants provide and the cost of attendance. And for some of them, I just don't think it's the right tool because it is producing outcomes that aren't good for them and aren't good for taxpayers or the economy. The Urban Institute has produced excellent research on the effects of default on borrowers, and I think we need to do more to avoid those types of outcomes for borrowers.
Let's talk a little bit more about income-based repayment, which got a little bit of mention, but not a lot. So what problems does income-based repayment solve, and what problems, if any, does it create? How much of a solution is that to some of the problems that have been identified?
Okay. So income-based repayment, so what it does is it allows people who are enrolled in the program to reduce their monthly payments to be commensurate with their incomes. So under the program, if you make less than 150% of the poverty line, then you can suspend your payments. The duration of your loan is extended. You pay it over a longer period of time. If you make more than 150% of the poverty line, you only pay 10% of your income above that line. So the idea is that for students who are early in their careers, where their earnings are lower than they will be, or for those who are temporarily unemployed, it helps them weather a period of their lives when they're not earning as much as they will later. I think that's a great idea to provide insurance against those hard times, like periods of illiquidity, and because the loan duration extends, it means that the taxpayers aren't necessarily on the hook for the full amount of that underpayment. On the other hand, I think it's a problem in cases where if students are systematically not going to repay their loans, and there's going to be large amounts of discharged debt, then I think there's a moral hazard where schools will want to take advantage of the ability to charge more for that education. Students are not on the hook for how much they take out in loans, and it ultimately be very costly.
I agree that the idea of tying loan payments to income is one that stretches back, at least 50 years, and other countries have had income-driven repayment plans with some of the similar features as ours for a very long time. The challenge in the United States is that we have a complexity of repayment plans, as I already talked about. In a country like Australia, a student will enter income-based repayment and will stay in income-based repayment the entire time and for the 20 or 25 years that they're paying back the loan. If they have higher monthly income than what they would under some sort of a standard repayment plan equivalent, they will pay more. There are no caps on monthly payments. So it's a true form of risk sharing in the sense that those with low incomes will pay less and those with high incomes will pay more. There's of course a cap, an amount up to which they will no longer make any payments. So even if you're a millionaire, you won't be paying 10% of a millionaire's salary for 20 years. You will finish sooner. So from that perspective, in the United States, borrowers can go in and out of income-based repayment. And if it becomes a program that borrowers only use when they're in distress, and that they don't pay more into when they're doing well, then we're not really following in the spirit of what an income-driven repayment plan is supposed to do.
Can I follow up on?
Yeah.
So I think Australia is a good example, and but also one that requires a caveat, which I think is that in Australia, well, probably many. In Australia, the system has worked well for as long as it had, because you were only eligible to get a student loan if you got into and attended one of their kind of flagship BA programs. It wasn't available at the kind of community college. You couldn't use it for a certificate. So it was, and the number of seats at those schools was limited. So it was really only people who had applied and who could get into the top schools who were offered a student loan. And so in that sense, I think there wasn't the problem of riskier institutions or students who, even students who were going to struggle because they had kind of already selected the types of people who were eligible for that program. And I think that they've since changed who's eligible, and I think that the finances of that program have eroded, and that they're struggling now with their financial aid system because now they have a much broader group of schools that can participate and get loans.
If I may add even a little bit more, I think you can think of our discussion here as kind of like an improv session. Yes, and. And all of the other countries where income-driven repayment is the default and where it works reasonably well have a limit either on prices or on seats. We have a very, very different system here of competition between schools and tuition setting, even at some public schools that is pretty independent of any kind of a central body, and income-driven repayment has very different challenges under such a system. We know that at for-profit colleges, they capture something like 70% of increases in loan limits in all kinds of aid available to students in forms of higher tuition. So it definitely is a problem we have to grapple with.
So sort of tease up the next question. So what kind of policies would, both cater to a broader audience, right? So not do the Australia thing where you're selecting just the people. If the policy idea is to help people get an education and to help first generation, all that stuff, to get education, and yet that's also where we see all the problems with the loans. I guess I have two questions there. One, we do see a lot of problems, but is it on net still a useful program for people? And also, so what are your top two policy ideas to change that?
I mean, I think that the United States has a great educational system, and so I think by and large it works very well for most of its students. I mean, I think we should have a stronger accountability system. First of all, that limits the conditions in which we make loans to students. I would prefer to have a system where we judge students based on their outcomes and looked at institutions that have a track record of producing students who have strong outcomes, and particularly strong outcomes for low-income students, and to prioritize those institutions in our aid formula so that those students are more likely to get financial aid, or for the government to help them get aid, to make sure that students who go to those institutions are eligible. And then for institutions that where students do not have good outcomes and where low-income students do not have good outcomes, then we should limit how much we offer them, or not allow them to take out federal loans. I mean, I think that's the simplest way of saying that.
Can I follow up on that before I give it to DeBarco? Are there enough? Oh, sorry. Thank you. Are there enough seats at those places? So, is there a problem also on the supply side, where community college is available, or how do I think about that rise of for-profits and why?
I mean, I think that is an important question. So, I mean, I think that we have one data point from our historical experience, which is that we had a crisis in the 80s, and that led to very high rates of default. And so we instituted a fairly stringent system where we kicked out schools whose cohort default rates were too high. We kicked out schools that were predominantly not online, but distance learning programs at that time. We kicked out schools that were too reliant on federal aid. And then we also asked students to be more responsible for their loan burdens. We garnished their wages if they didn't pay, and we instituted we didn't let them discharge their loans in bankruptcy. And so there was kind of a shared responsibility, and that led to the closure of thousands of schools. The evidence is that those students went to local community colleges by and large, instead of the for-profit schools that were most stringently hit most by the rules. And so at that time there are seats. I mean, I think that it is an important question. If you change how we do this, it will require students to move from one institution to another. And so I think it's important to do that. I mean, in some sense, the aid flows with the student. So some federal resources would automatically shift to other institutions. But I think that's an important thing to care about.
So I'll start off by saying that one of the questions that I hear the most and that I get asked the most, especially by sort of economist, market solution types out there, are, why do these bad schools continue to exist? How can they be sustained? And I think it goes really back to something that we haven't really touched upon yet in the session, and it's this inflated level of demand for college education. We have convinced families that going to a college, and maybe to a four-year institution specifically, is the only path to the middle class. It's something that they should strive for no matter the cost and stretch themselves financially. And in some cases, they should, but if I thought that for-profit schools would, cease to operate if we eliminated federal funding, I would have different policy solutions to suggest. But I don't, and I think that families will find other ways to, by and large, to enroll in these programs. And there are plenty of certificate programs out there that where families pay the full cost and they're not eligible for federal aid. So I think we have to be careful with limiting aid in terms of reducing the number of available seats too much. That being said, I do agree with Adam that there are some accountability policies that are in order that would weed out the really bad actors. And beyond that, we can then focus on income-driven repayment and other tools to help the people who go to reasonably good schools but don't have such great outcomes.
Great. All right, I'm going to open it up to the audience. Raise your hand. We'll have a mic coming around. I'm going to take like 3 questions, if we have 3 questions, before we answer. And please stand up, give us your name, tell us where you're from.
Hi, my name is Deborah Ray, and I am the founder of a nonprofit educational organization, Código Ecuador, teaching Ecuadorian women to code. And my question is, how much of the bad outcome is actually driven by the stigma surrounding for-profit colleges? And how do we, facilitate greater competition in the educational industry and help those for-profit colleges succeed rather than, continuing to place the bad label on those institutions? And also, what is the actual marginal cost of each student going even to a public university? And what is the premium that is placed on them in tuition because of the greater availability of student loans? And how do we classify those actors who charge that much?
Thank you. I'm Dave Rabinowitz, retired. I was wondering if there's any way to get the institutions to share the risk on loans. Right now, the risk seems to be totally on the taxpayers.
I mean, so on the question of like for-profits, I think philosophically, I don't think there's I don't have a personal aversion to them. I don't know why they would offer a different quality of product. I mean, the vast majority of things that I purchase in my life are produced by for-profit entities, and when I go to Costco or I go to the doctor or when I buy a Toyota, that seems to work out fine. I think in the educational space, there is more of a problem in the sense that people are often not paying with their own money or have the perception of not being on the hook for that, which contributes to, I think, more of a disassociation between cost and value. And to be fair, I think that there are for-profit schools that do a good job. I think there are parts of the medical field that are where for-profit schools are the predominant educator of certain specialties, and I think people value their work, and there is not a stigma in those cases. But by and large, it's clear that if you look at the outcomes of the students, a lot more students who go to for-profits, especially the large chains, seem to struggle a lot more.
Agreed. There are for-profit schools out there that produce perfectly good outcomes. They tend to be, from what I can tell, focused in fields where competency-based or skill-based learning with short-term programs with great measurement of pre and post course earnings is really robust. Those are the ones that do well. So, I hate to be the economist who, stands here and basically says more data is a solution to everything. But in this case, I really think it is. Those schools that can make a good case for value added, and in the case of short-term programs, you can really argue that whatever your boost in earnings is after a 6-month program is due to the program and not becoming older, more experienced, and all these other things. The schools that can really show that link very tightly will do well. It's a different set of objectives than in traditional 2-year and 4-year colleges, where the public return in terms of better educated workforce, less reliance on welfare systems, lower crime rates, and all these other benefits we know come from higher education. For 4-year and 2-year institutions, we can also look at that. But for the competency-based, skill-based learning, it really is about the earnings, and so we should measure that really well and show our case.
And what about the relationship between tuition and the loan system, and like which direction does the causation go? And is it true that the availability of all these loans is one of the factors that's pushed up tuition, or is it a response to the rising tuition?
I think I'm not the. I think there are other experts in the audience who would probably be able to answer this question better than I am. I think that there is some evidence that of the Bennett hypothesis, the idea that increases in federal aid or financial aid increase tuition. And so I think that there is some case for that. I also think that the response of policymakers has been to increase loan limits and things like that in the face of rising tuition. I guess one other thing to say is that if you look at the sticker price versus the net price, in a lot of cases, the net price has gone up by much less or not at all than the sticker price, in part because schools do more individual pricing, charging more for higher income students and less for lower income students. And there's have been increases in grant aid over time that has defrayed some of that cost. So I think that the relationship between how much schools charge and the loan system is just more complicated and not as straightforward.
Why don't I just go to institutional risk sharing, just because we're running out of time here. So,
I'll have to punt that back to Mr. Accountability here.
I think that there are, in terms of risk sharing, I think there are a lot of ways to impose accountability. And so I don't think that the system that we have now evaluates an institution based on the one particular measure of the outcome of its students, and then the default rate. And then if the default rate is too high, then the sanction is you're no longer allowed to participate in the loan program. That has some nice features in that it's transparent and it's simple, and it only kind of applies to a small fraction of schools. On the other hand, it is that means that for schools that are not near that threshold, they don't care necessarily a lot about that sanction, and they don't have a lot of incentive to improve the outcomes of students through that kind of system. And so one could design a risk-sharing system or a system of accountability more generally that looked at the outcomes of students and applied incentives at a wider variety of institutions. And I think that would help drive the institutions to care more about the students' outcomes.
Okay, well, we're out of time, but we were coming back to this whole question of student loans in our next panel. We have a short break now, but please join me in thanking our panelists.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.